Okay, let's just delve into the considerations before the Monetary Policy Committee. There are the meetings, two-day meetings starting right now. Let's begin our countdown and outlook on this two-day meeting. Bolahan, I know head of investment at Controls Capital is live here in the studios with us. Let's just go into this straight away. Good morning.
Good morning, boss.
If there's anything on the minds of the market as we speak, it's going to be the MPC, even when everyone there's a lot of consensus that the body will hold rates unchanged, but everybody still await what will be said in the communique because there are a lot of, we saw the devil is in the details, as it were. So the rates may be unchanged, maybe be left unchanged, but there's a way in which you find a lot of statements in there that could move the markets. So in the countdown, and we've just showcased some of what your colleagues in the market are saying about this two-day meeting. What's your view at Controls Capital?
Okay, thank you very much, bossy. So in line with consensus view, I think we are pretty much in line. But like you said, it's very important to understand what is in the communique. So if you look at the last communique, two of the committee members actually voted for a rate cut out of the 8 people that were seated at the meeting. So there were meant to be 12, but just 8 attended. But 2 voted for a rate cut, 6 voted for status quo. And of course, pretty much understandable. Of course, Nigeria is coming from recession. So that was their own consideration that we need to spur growth in the economy. But what has changed from the last MPC meeting? Pretty much nothing has changed. But one big thing that has changed is the GDP figures that we saw. Also, Nigeria on the path of recovery. Also, the MPC also made it clear that they think there should be a rate cut, but they think it might be premature. They think that the economy is still pretty much fragile. So a rate cut might more or less make all the gains counterproductive. So while they all think that there should be a rate cut, they just think it's too sudden. And for them, they think that one, real interest rate has been attractive for FPIs. They also think the fact that there have been a lot of foreign exchange gains. Naira has been stable this year on the back of I&E window, on the back of FX liquidity as well. So they don't want to reverse that gain that we've seen. But of course, they all think that there should be a rate cut. But I think we're not going to see a rate cut in this MPC meeting. This
consensus on no change to key rates will be there. But again, if we drill down a little bit on those 2 members of the committee, 2 out of 8, that says there should be a rate cut because they're looking at some argument for easing. Do you think these arguments are strong enough? Do you think at tomorrow's meeting, these 2 individuals, MPC members, will pick up the GDP second quarter numbers and say, look, this looks good enough. This supports our argument for rate easing. And again, look at inflation trending lower, even though some analysts believe that is still is a little bit soft for us to begin to, because they're having a bit of a longer outlook on inflation, still sticky to the north, all the way above the central bank a range of 2 to 9%. So do you think there's still the argument for easing still hold water? Do you think perhaps more members out of the 8 will be convinced? Then we'll begin to see a bit of a more pressure on those who said, let's hold rates, for them to go for a bit of some easing at some point.
Yeah, so I think the argument for easing is strong. So if you look at our counterparts, South Africa, they also went into recession. And what they did in July was to reduce their rates by 25 bips to 6.75%. And when they were going to come out of recession, their own growth was more than 2%. For Nigeria, it's still a bit of crawling. So obviously, you need to spur growth in the economy to make things less expensive. So of course, we know that things are a bit expensive in terms of borrowing costs, in terms of lending costs. And for a lot of manufacturers, they've always complained about lending rates, borrowing rates rather. They've also always complained about liquidity. So of course, the argument is strong, but I think it's just too quick. It's a very strong argument. And I think for Nigeria, even apart from the fact that we're coming out of recession, I think one key thing is when you look at the GDP per capita for Nigeria is not too attractive. We are like 140 out of most countries, which is not good at all. If you look at the growth rate of the economy of the population as well, going at about 2%. So a 0.55% GDP growth does not cut it. So obviously, it's obvious that there needs to be a rate cut, but I think it just might be too sudden.
Do you think the hold rate members of the MPC could say tomorrow, and say, look, okay, well, we listen to everyone. Let's test the waters and say, let's go for a little bit of haircut to test whether the banks will respond, even though they've been stubborn not responding and not transmitting the previous cuts, including what you call the CRR, public sector CRR cut twice. About 25%, they've not transmitted those monies into the real sector. They keep lending to big companies, and they are lending to capital-intensive and not labor-intensive, to use the words of IBN Quest research team, their money note today. So do you think, and by how much do you think Godwin Emefiele and those who are for let's hold rates, by how much do you think, if you want to test the waters, is it by 1/10 of a percent? 0.25 like our South African friends?
Well, so there are going to be a rate cut. I would think 25 bips. But of course, clearly ruling out a rate cut. But what the CBN have done of recent is to bring out treasury bill rates. So if you look at the treasury bill yield that we've seen in recent times, it's been coming down significantly lower. Even the OMO issuances, so that they have not been issuing the long-dated tenured OMO, it's just been the mid and the short-dated one. So I think that's a deliberate effort to bring down the yields of fixed income instruments. So I think that's going to continue. But in terms of rate cuts, maybe the MPC meeting in November or maybe next year, but not for this meeting.
Not September. So you don't see whichever way.
So if you look at the body language of the communique, it was clear that the FX environment is still very, very fragile.
So you think this MPC will concentrate on the markets?
Definitely.
In terms of the treasuries, the bonds, and the stock market, and the FX as a basis for let's hold rates?
Yeah. So if you look at their language, they've been strong on the real interest rates, they've been strong on inflation, they've been strong on FPI. So I think that's going to form a basis for them holding rates.
How do you think the market should continue to trade after this meeting? So it's going to be a no-hold rate unless these team members decide to surprise all of us.
Yeah, it's going to be a big surprise. Yeah,
which they usually did once in the last 1 year.
Yeah, in 2016, there were a lot of surprises.
Yes.
Yeah. So I think what they'll do, so for market participants, so really the MPL have not really formed the basis. So yes, we've been watching treasury bill rates. And if you look at the last NTB auction on Wednesday, it was oversubscribed, most especially the mid and the long by 4 times. So I think we're going to see a lot of participation in the long-dated space as investors want to lock in their funds. Also for bonds as well, it was a bit bullish last week, and we saw rates contract. So I think we're going to see a lot of participation in the bond space, a lot of participation in the fixed income space, especially at the long end of the curve. Because really, investors want to protect themselves against reinvestment risk. So why not lock in when you expect rates to come down in the coming months?
You think that is what is happening? Then the DMO is doing 135 billion naira this week.
Yes, so they are raising 35 billion in the 5-year bond. I think 50 apiece in the 10 and 20-year bonds. So I think it's going to be oversubscribed. I think I'm going to see a lot of participation in that space.